Selfwealth Live and Learn this week. It's a technical analysis edition or traders edition. I'm excited and pumped we're here again for another week. Jason, hello to you, and how are you going?
Hey, Rog, I am all pretty good, thanks. And we've got an interesting show for everyone today about short selling. And even if you're not a short seller, which I think most people aren't, I think there's some interesting stories here that, I think people will find fascinating.
Yeah, exactly. And before I introduce our topic and what we're going to go through today, did you want to just go through our lovely disclaimers that we have?
Absolutely. Yep. So everything we do today is general commentary only, no personal advice given. And just quickly popping up our disclaimer, which outlines all that. And another important point to note is that I'm not part of Selfwealth. I'm from Motion Trader. My business is Motion Trader, and you can see all the details and licensing details with that in that top disclaimer. Selfwealth has a note below, and again, it outlines that everything is general commentary only.
Fantastic. Thanks, Jason. Obviously, I'm saying hello to everyone here, and thanks for coming week in, week out. Don't forget to like and subscribe. Send comments in. We had a great question from a client through our support channel. So even if you send it through our support channel, somehow it gets to me, and I'm able to help out there as well. So it's I really appreciate all that. Now, this week, I've got a quick joke, which I'm sure everyone's heard of. But this week, we're going to go through the markets as we do in general. Our educational topic is around short selling. And the reason why I chose that this week is because it's just purely educational, right? We don't offer this on Selfwealth. We don't offer short selling. I just want to make that clear, right? You can buy and sell, but you can't do that short selling the way traditionally that it's known as, right? So just to be clear there. All right, so it's just around education, because it's great to know how how it works, and a lot of great movies as well. A lot of great entertainment is based on some big stories where short selling's happened, right? So hopefully we hopefully find this entertaining topic to learn about if you don't already know about it, right? So, but before we go, Jason, I've got someone told me this one. How do you have $1 million in your account? How do you get $1 million account in your account?
Would it be something like start with $10 million, buy a vineyard, and then you got $1 million, or a variation around that?
Exactly. So they just told me to start with $2 million, right? So I think this is pertinent to the short selling conversation, right?
A few variations of that. You could say you start with 10 million by boat. You start with 10 million by a few racehorses, by a vineyard. Yeah. I think the list goes on. You just fill in your fun activity, which is expensive but doesn't necessarily produce much return, but a whole lot of expenses along the way.
Yeah, I heard that for a second time in my life this week. Someone told me about it, and I just have a giggle every single time, right? So I thought I'm just going to start with that. All right. Hello, everyone. Scott, Shannon, Hassan. Hello, and Tom. Welcome. Let's get on with the markets. It looks like they're going a bit. They're just struggling. Well, there's a few that have gone up, but a few others are struggling. How's the ASX going there?
Yeah, just since we spoke last week, we've had a bit of a modest sort of pullback decline, not too much. I'll actually jump over the chart and we'll just have a look at it on the chart. So there's our ASX 200, and so just a bit of modest weakness over the week. But really, the ASX 200 has been trading sideways for pretty much the last month. There hasn't been a whole lot going on. And it's interesting, Rog, that we see that this pause is happening around this major overhead resistance point. You can see these highs from 2021 and 2022, and then our recent one in December. And this is very much where the market's paused. And we spoke about resistance and supply a couple of weeks ago, and we are getting that. It's very much true to form. This is where the market is finding that pause, that supply coming in. And the question I've been asking over the last few weeks is whether we're going to get more backing and filling. You're looking at that October low, looking at the big rally off the October low. Do we now need to do more backing and filling to work off that move, or are we getting set for a series of new highs? And as I've said before, my thoughts are that we probably my thinking is where the probability favours a larger consolidation of just because these moves from October were so strong. We came a long way in just a couple of months. It would just be normal for the market to spend several weeks or even several months just doing that backing and filling before potentially we get another run higher. I wouldn't even discount a move back towards the 100-day moving average. So I've got the 50 and the 100-day moving averages. And quite often when you get a market that cycles from below the moving averages to above, you do get that initial pullback to the 50 and then also often to the 100 as well. So I think that's something which could very much get. But look, that hasn't happened so far. There's clearly interest in buying every dip and just looking at these dips. So this first dip we had lasted 12 days and came back 4%. Then we got another dip. It was even shorter, 7 days, came back about 3%. And this last little dip has been really short, just 3 days and a couple of percent. So we do need to, I think whilst I'm saying, look, I favour we get some sort of pause, you've always got to consider the other side of the scenarios. And look, it always is possible that this market does break high and then continue to accelerate to the top side. And the point which I've come back to several times in recent weeks is don't lose sight of the fact this is a really big trading range the market has been in. 2 years of coiling up, going nowhere. When it does release, whether it be now or whether it be in several months, and if it does release to the top side, it could really lead to a significant move. So that's the thing I want to be aware of. While I favour that longer consolidation, if it does happen, if we do get that break to the top side sooner, I don't want to be on the sidelines waiting just because I think a pause would be fitting with the type of price action that we often see around these points. These big sideways ranges do often lead to big moves. So should that happen, I want to have some players on the field. I want to be in the market. So I'm long ASX stocks, and just that terminology I use, long. It's long means I own. I've got a portfolio of ASX stocks. I added some exposure over the last week as I've been getting some new buy signals. And but having said that, I'm hesitant to chase stocks that have run hard. My preference is to look for stocks with fresh breakouts, maybe like coming off their moving averages, those sort of situations. And I'm also using wide trailing stops. So if that larger pullback that I've been thinking could happen, if it does eventuate, those wide trailing stops can hopefully help me see that off. Then if the market runs, I've got a significant position already. So, and I think, Roger, I think this is interesting. I think this is where having that systematic approach really helps. So I'm kind of preparing myself for whatever happens. So if the market runs, I've been buying along the way as prices have been rising. But if it comes back, I've got that exit plan around my wide trailing stop. So at the moment, it's about, as it always is, keeping upside open whilst managing risk.
Yeah, fair enough. And some of the talk that I've read in the US, and we'll get on the US market soon, is that let's say stocks on the NASDAQ is only your big stocks that are really bringing up that side of town, right? Is it the same? Do you think it's similar here in Australia? What's the All Ordinaries look like? Are they doing the same as the Aussie 200 or?
Yeah, it maybe looking at the equal weight, the S&P, the ASX 200 equal weight, and you can see it's still a considerable distance below its all-time high. And so this is where, equal weight, of course, where the ASX 200 is market capitalisation weighted. So BHP and CBA and those big stocks, they're really the dominant force. But then when you make it equal weight, BHP's as big as stock number 200. And when you look at it that way, you can see it's, we're not at all-time high. So that shows the influence those bigger stocks have been having in the ASX 200. So probably not to the same extent maybe as we've seen in the strength of some of those big US stocks. But yeah, look, it is along that sort of that sort of line. It's what I do. I look for individual situations within the overall market, and you can find strength anywhere from small to mid to big caps, and it's about like identifying the potential for strength and then going with that strength and managing your risk.
All right, let's have a look. Speaking of that, let's go have a look at the US markets then. What do they look like?
Yeah. Okay. So S&P 500, and look, another new all-time high just on what was it on Friday? New all-time high for the S&P 500, and that follows a brief sideways consolidation. It wasn't very long. It was only about a week and a half where the market paused, went sideways for a few days. Similar to what we saw back in late December, early January, although this one was a little bit longer, but really brief. And pretty much since this time around December, I've been looking more for a retest back to these moving averages, and that hasn't come. This has just been a relentless move higher, and the buying interest quickly comes in any pullback and fuels another rally. To me, when I look at it, it does look and it does feel like it is stretched to the upside, but that's what I've thought for the last month and a half. And but this is the thing with trends, that they can run further and last longer than people often think, and so this is why I avoid strategies where I come in and take profits. So whilst I've been thinking, look, this market looks like it needs to pause, I've been saying the whole way up, it may look like that, but the strategy is, if you're in positions which are working, let them keep working. Don't short circuit that potential to make money because you think that it needs to pause. Because as I say, these markets can keep moving for longer than a lot of people think. I want to cut losses when a trade isn't working, but I also don't want to cap upside when things are running. And trying to call tops, I think it's pretty much a fruitless game. It's sometimes you get it right, but more often than not, the market rolls over the top of you. So I think as I've said for a while, I think staying with the trend here remains to play. And as I often talk about, use those wide trailing stops to help you manage your risk. So you're staying with the trend, but you've got an exit plan should things reverse. And the aim is to be able to see off those moderate consolidations like we've seen in January and earlier this month. And you just think, had you seen this bit of a pullback developing in January and said, oh, look, it's done enough, I'm going to get out, and you're looking at it now, well, you'd probably be disappointed you got out if you didn't get back in. And often that's the case. Once people get out, they often don't get back in if they're looking for a bigger pullback to develop. So, look, don't get me wrong. I think the risk of a meaningful pullback is increasing. Every upward trend eventually comes back to these moving averages, but we just don't know when. So I think play here, keep upside open, manage risk with that trailing stop.
Yeah, and that's good. Can we have a look at the Russell 2000 and have a look at its similar picture? Or?
Yeah. The Russell's interesting. It's just called up here. This is one I've been keeping a close eye on. It's really starting to coil up below this December high. So you can see the high from December, and the high from December looks like the initial stages of a breakout from this big range that the market spent some 18 months or so in. Looks like we're on the cusp of really breaking out of this. So we've got the December high coiling up beneath it. Each time the index has come back to the 50-day moving average, we've got a strong reaction to the upside. So that's happened on 3 occasions now. So it's clearly interest in buying that dip. And so from a risk reward play, I think the smaller stocks are really one of the most interesting sections of the market. If we see the index break above these recent peaks from December and then earlier this month, I think that would be a buy signal in the Russell. Plenty of US listed ETFs to play that. There's not a local listed Russell ETFs. This is a Russell 2000. I don't think there's a local listing, but you can do it through the Selfwealth platform in the US market. There are several ways you can do that, or of course you look for stocks within this category, and that's that's the sort of thing I'd like to do. Like look for the individual situations, get in the individual stocks. That's where you're cherry picking potentially the best part of an index rather than getting a whole index which has all the best parts and the worst part. You look for the setups above the moving averages, stocks which are running, they're the ones that you shortlist to consider. Whereas even in a rising market, you'll get stocks which are below their moving averages and you can just leave them to the side. But yeah, I think the Russell's looking pretty interesting, Rog.
Very good. That's good. A lot of positive. Well, I don't know if this is a positive thing, but there is a lot of talk about Trump at the moment doing very well in their campaigns out there at the moment. I wonder if it's got something to do with it. But either way, I think a couple of weeks ago we talked about the China and Hong Kong markets turning around, and they seem to be doing so a little bit. You want to have a look at Hong Kong specifically?
Yeah. So, Hang Seng. So we did a couple of weeks ago talk about we'd had this initial run. We've had a bit of a sideways period. Maybe we'd have another move up towards the moving averages, which we've had. Last week I was talking about potentially moving into a potentially vulnerable situation with price getting back to the 50-day moving average. And you can see previous times where the price has come back towards the 50 or the 5100, where it's then peaked and rolled over. So far that hasn't happened. It's strengthened further up towards the 100. My thinking with this is that maybe it's still early. It's still too early to say whether there's a turnaround based on this because the moving averages are still trending lower. But it's interesting when I look at the Chinese market. So this is the Chinese market now, which correlates quite well with the Hang Seng, and it's cycled from below the moving averages to now it's now above the 100-day moving average. So that's a potential positive. Now, if this market can now hold its ground and consolidate, move sideways, let these moving averages start to turn higher and cross, well, then maybe that's setting up a positive backdrop for this market, which has been really out of favour for several years. And then, of course, that bodes well for the Hang Seng. So there's a bit of work to be done here yet, but I think it's one of those ones to watch.
Yeah, it's good. It's positive news for the Hang Seng there. All right, let's get on to our topic then for this week. Short selling. I'll have to say one of my favourite documentaries on this topic is, have you ever seen Betting on Zero, Jason?
I haven't seen that.
It was the Herbalife short. Pershing Square, what's his? I can't remember what his name was, but the big hedge fund manager there, Ackman, Bill Ackman, I think. Yeah, it was a great documentary. He lost. I shouldn't say unfortunately, because I don't think short selling is a positive thing, but he lost that and lost a lot of his, I'm sure, investors' money. But it's a good documentary, Betting on Zero. If anyone has a look at that, it's a great doco. But short selling, we don't offer it once again, so please don't come to the platform and try and see if you can short sell. Jason, what is it? What exactly is short selling?
Well, short selling is basically the opposite to when you buy a share. So you buy a share, you buy it and you want the price to go up, and then you sell it. Short selling, you're doing it the opposite way around. You're selling something now that you don't own. So you're selling something at hopefully a higher level and you're aiming to buy it back at a lower level. And a lot of people will think that, well, look, that sounds pretty straightforward. I think, well, look, I buy plenty of shares that don't work out and go down. So surely finding losing stock would be a pretty straightforward process. Lots of stocks don't perform that well over time. So shorting should be straightforward. But it's actually a lot harder to make money from than I think a lot of people have in mind when they first go and consider it, with the way volatility works and the costs involved with short selling, which we can come back to a little bit later on, but not quite as straightforward as people think. And I'll start with a bit of a story about short selling, and I think this is what really captures the imagination and why people think short selling is, it does get people enthusiastic to give it a go. So this goes back to I was 19 back in 1992. So I just started in the dealing room, so I remember all this taking place. It was I was on the foreign exchange desk at the time, and I'm going to share my screen again with you. I'm going to go back to show you something from a website. And so this guy here, this is a guy called George Soros, and he's this is one of the most famous short selling trades of all time. So he was a famed trader back in the particularly in the 90s and probably the early 2000s. And his name's probably started to drift from memory, particularly with younger people. Probably aren't familiar with him. But in the 1990s, he really was he was a household name. People who weren't really even involved in the market were seeing his name across the headlines, across the news reports. And so this is a picture of George sitting in his office in New York, big leather chair on the old phone, doing what he does, trading in the markets. So this story is about when he went short the British pound. So and as history goes, he made $1 billion in one day. So the way all this worked is that back in the early 90s, the British pound was pegged to the Deutschmark. So we have the euro now, but back in the 90s, the German currency was a Deutschmark. So the British pound was pegged to the Deutschmark. And the German economy was doing better than the British economy, and Soros took the view that this peg, this linking of the British pound to the Deutschmark, wasn't going to be sustainable, and the Bank of England was going to have to devalue the currency. And so he took this massive short position against the pound. So it was $10 billion. So I'm going to go to a chart. So this is the British pound back in 1992. It had been trading up for a couple of years because that's what the Deutschmark had been doing, and the pound is following the Deutschmark due to this peg. And Soros starts placing these bets that the pound's going to fall, that the British central bank, the Bank of England, can't sustain the peg. So he sells $1 billion first, and there's some weakness. So he's selling into weakness. So this is one of the strategies which I talk about in terms of like go with the momentum of the market. Sell into weakness, buy into strength. And so the market starts to give way, and the Bank of England tries to defend its position. It starts to buy the currency. It increases interest rates, and Soros said he saw that as the desperate last moves of a bank which was on the brink of being defeated, and he came through with more selling. Other hedge funds jumped on, other banks jumped on. Soros ends up with a $10 billion short position, and the Bank of England gave in and let the currency decline. And you can see, like, this is versus the US dollar, from a currency rate of 2 down to within a couple of months down to 1.4. So that's a massive move for a currency. To see a major currency move that far that quickly doesn't happen very often. So this was short selling. And there was this massive wealth transfer from the British taxpayers over to Soros's hedge fund and others who were doing something similar. Ironically, it made the British economy more competitive, and the British economy went on did really well over the next decade or two. But that's another point. But so I think when people think of shorting, they're often thinking about these fast and big wins, like Soros had. But the reality, it's look, I think for most people, this isn't the reality. They don't get these big, spectacular short-selling wins like Soros did. So that's the legend that gets people excited about the notion of short selling, but yet the reality is often quite different.
Yeah, it's a good example, that story for sure. So it's a good success example, because there's been many failed examples as well, which many movies that have been made of. I'll mention another one afterwards. I just saw a couple months ago, a couple weeks ago. All right. So how risky is it? Now I know it's complex. The way it works is complex, but how risky is it?
Look, there are a few things to consider when if you want to trade short. So firstly, markets tend to be more volatile when they're coming down than when they're going up. So there's the old saying that markets go up the escalator and come down the elevator. So it's ratcheting higher, but then coming down with a thud. And when something comes down quickly, then also often rebounds quickly, and that's where you get volatility. So it's a lot harder to stay with a position which is falling and then rapidly rising and then falling again. So that's volatility. So that's one of the risks with shorting. And there's also funding costs. So you buy a share, you pay your brokerage, and you're pretty much done. With shorting, there's costs involved, because you can't just sell something which you don't own and you don't have. You've got to go and borrow it from someone. So what a fund will do, they'll go to a broker or another fund who's holding the shares, and they'll borrow those shares. So they'll pay them a funding cost, and then they'll go and sell those shares and then ultimately buy them back and return them. Retail traders tend to use CFDs, and CFDs, there's funding costs with those when you go short. So there's costs involved when you want to trade short. And the other thing is the how the mathematics of the whole thing works. The mathematics of trading short isn't as good as when you trade long. So you buy a share, it can go up, it could double, it could go up 100%, it can go up 200, 300, 400. It can go up a multiple of what you bought it for. And your maximum downside is 100%. So it can go to zero. So you can lose 100%, or you can make a multiple. And this is assuming no leverage. It's just assuming you go out there and just buy it with money in your account. Now, shorting's a bit different in that the most you can make is if it goes to zero. So you can make 100%. Remember, with buying, we can make a multiple of what we invest. With shorting, your biggest return, assuming no leverage, it goes to zero and you make 100%. And that's a pretty rare occurrence that you make 100%. You look at your downside, and well, it's uncapped, because a stock can still go up infinitely, and still double and triple and so forth. So you've got unlimited, unlike when you buy, where you've got limited downside and unlimited upside. When you're short, it's the opposite. You have unlimited downside and limited upside. So it's not that same asymmetric positive skew that you get when you buy. And so it tends to, over time, it tends to be a less profitable pursuit. So in all the back testing I've done and all the systems I've seen, shorting is typically, often it doesn't make any money over time. Over time, it tends to not be profitable. Whereas trading long is. So these are the things to consider when trading short. So I want to tell you another story. So I'm going to go back and share my screen. So we talked about Soros a bit earlier. So I'm going to tell you about at the other end of the spectrum. So this is this is another story. It made the headlines, not as much as Soros, but it did make newsfeed headlines. It's about a retail trader. Goes back to 2015, so not that long ago. 2015, small business owner, a novice trader, a guy called Joe Campbell. He's tried his hand at trading short. And he had his E-Trade account. He had $37,000 in his E-Trade account, and he shorted this stock called. It was a pharmaceuticals company, And so the share price hadn't been doing much. There's a lot of negativity around this particular stock. 49% of the stock had been sold short, so a lot of people were thinking the same way as Joe. And so Joe thought it was, look, this is a sure thing. So and just earlier, the company had come out and said, look, we're winding down our operations, we're running out of cash, and so it looked like, look, if you're going to pick a losing stock, this seems like a losing stock. So this guy, Joe Campbell, he's got his $37,000 E-Trade account. He puts all that money into going short this pharmaceuticals company. And no sooner has he gone short, the company's come out and announced they've got an investor who's bought a big chunk of the company. And so this is where you can see on the screen, the lower end of the chart, this is where Joe went short. And then the shares has just taken off. It's literally taken off overnight. There's been no chance to close this position out. And this is the greatest risk when you trade short, in that the market quickly moves higher and you don't have a chance to close your position. Some sort of a takeover, some sort of a big scale event where there's a dramatic repricing of the stock. And so Joe comes in, he thinks, look, I've probably lost my $37,000. He'd done a lot worse than that. Not only had he lost his $37,000, you can see up at the top of the screen here, trader loses $106,000. So he's gone from plus 37,000 to minus 106,000. So he owes E-Trade money because he wasn't able to close out his shares as they gapped higher. And this is the thing to remember with shorting. Shares don't have an upper limit. And so I think for anyone who wants to think about shorting stocks, I think they've got to have experience around the area, and they've got to understand it, and they've got to have careful risk planning. And you can look up these stories yourself. You can just type that headline into Google, and you'll get the story below, and you can read all about it. And the same with Soros. Just type in this into Google, and you'll find the stories. Really interesting stories to read. But yeah. So unlike our friend George, Trader Joe didn't have the same success. Going in there, big bet on a short stock which he thought was not doing much, and it just shows you can't just think about what you think you might make. You got to think about, look, what's my downside? What could I lose if this all goes wrong? And in short selling, it can be truly catastrophic if you have a big bet that goes against you.
Yeah, so once again, short selling provides unlimited downside and unlimited losses, right? Can provide you that. Whereas if you buy, you're only limited to the amount of capital that you've actually invested, right? If the stock was to go down to zero, which is a good point. Scott's asked, do you have to lodge funds with your broker to cover the share price rises of your stock for shorting? So, like, let's say it's going up bit by bit. Do you have to keep on paying them as it goes up, or do you just pay them right at the end when you want to?
Well, that would be that would be margin calls. So a broker is going to want if a trade is going against you, the broker is going to want you to put up more capital to underpin that position, and that's called a margin call. So if you're using leverage, if you're buying shares and you're using leverage, or you're trading futures, or you're trading CFDs, there's going to be a margin call if the position's moving against you. It's a way of maintaining the integrity of the financial system. Really, you don't want all these big players with these big bets on going against them, just assuming they'll be able to settle up if and when things go wrong. They've got to be topping up their account as things are going against them. But in the case of something like we saw with Joe Campbell, there was no time for a margin call because the stock literally went up overnight. So it closed at one price and then it opened at another price. So there's no margin call there. That's how he's ended up with that big negative equity position. In the normal course of business, if it took the stock 6 months to move to that height, he probably would have closed the position out. But this is the thing: when you trade short, you do have that risk that something, and this is when you use leverage generally. You could be buying shares and using leverage, and something from left field happens, and there's an immediate repricing, which doesn't give you the opportunity to exit, and a lot of damage can be done. So leverage is a very it's great when it's working for you, but when it goes against you, it can just absolutely tear you apart. So you've got to be really careful with and strategic and thoughtful with how you use leverage.
Yeah, exactly. And traditionally, shorting a stock is very complex. Finding that broker that's able to do it for you. These days, you can go to CFD platforms, which is super risky, and just click a button almost and short a stock. But you are using margin, and if you don't understand it, it's definitely a double-edged sword, and it can really hurt you, right? So, definitely, I understand how risky it is, and we're just here just to try and explain what it's all about, and you making sure that you sort of do all your homework and understand all the risks there as well, right? Protecting your capital.
A lot of promoters I see, also particularly around the foreign exchange or the FX space, which Selfwealth doesn't do. And I think there's a good reason for that, because a lot of the promoters around that, there's a lot of talk about what you could make, about the riches that could follow, but you don't see them talking about Trader Joe in their examples and their risks. There's more going to be about look at Soros and or look at these fabulous results, but with reward comes risk. Risk can never be overlooked, although it's not as exciting to look at risk. It's the realism we need to have when considering whether potential high return ventures are worth being involved in, because you've got to know that downside.
Yeah, fair enough. All right, why in the end do retail and retail clients, let's say maybe the retailers do it because they've heard the story and they want to make a lot of money on the short side, but why do institutions do it? Why do retail institutions do it?
Well, you got the hedge funds, for instance. The hedge funds are like George Soros, and they'll do it for profit. They'll do it because they think they can make money. A lot of them can make money out of short selling, and so they'll take it from that perspective. Other institutions, fund managers even will use it as some will use it as a hedging device. So they'll own some stocks and they'll be short some stocks, and the idea being when the market's rising, their long stocks are rising by more than their short stocks, which may even be falling. But in a down market, their short stocks will help buffer any losses from buffer the losses from their long positions. So it tends to, what it can do, it can smooth out volatility. So that can be useful for a fund or a hedge fund that is using shorting for those purposes. It's in all the back testing and done. I mentioned this earlier. When I've done back testing, I've looked at other systems that use shorting components. The shorting components often, when you look at shorting as a standalone strategy, it just doesn't make any money. And you look and go, well, why would you bother? Why bother doing this? Because it's not overall over time. Yes, we'll have some big wins, but overall, it's just not really making much money. It doesn't justify the risk. And but when you combine it with a long portfolio, you can see that can smooth out the equity curve. So that's why you will get institutions or hedge funds using short strategies. I think from a retail perspective, a lot of retail traders do it just because I think they're going to make a lot of money quickly. Some are going to be more educated; they might use it for their hedging, or because they understand risk reward and they can see setups. But I think a lot of people come charging in with ideas that, look, I should be able to pick a dud stock, so I should be able to make money short selling. And I think short selling probably doesn't work out too well for a lot of those people over time. But But look, shorting's part of the market. It helps provide liquidity into the market. It can help identify issues within a company. There was it was interesting. There's a US hedge fund which was in the news in recent years. I'll share my chart. I'll show you something. It was let me just get back to these charts. So there's a local company, Rural Funds Group, and this period I'm going to show you. This was caused by a short-selling hedge fund. So you can see the shares have been trending nicely. I actually owned some of this at the time. It had a buy signal on it. It had been in a nice uptrend. And then this short-selling hedge fund released a report saying that the company there was all this stuff behind the curtain of the company which people weren't aware of. It wasn't doing well. Things weren't as they seemed, and it caused a collapse in the share price. So Rural Funds fell from no hint of trouble to down. What's that? Down 40% in pretty much a day. Then the company came out and refuted what had been said. The share price rallied. There's still volatility around it, and it ultimately was proven the hedge fund was probably in it to just make money with their, and the shares went onwards and upwards. But prior to this, there was another ASX listed company, a company called Blue Sky. As a fund manager, Blue Sky Investments or something to that nature, and that the same fund had come out with a research report on that, which ultimately led to the stock going to zero. So the short sellers won that battle. They moved to Rural Funds and won a war but didn't win or won a battle but didn't win the whole war. So it was. They can provide information to the market. They can it increases liquidity. So shorting isn't a bad thing, but it's something that isn't straightforward for, I think, everyday investors to make money from.
Yeah, it's interesting. The whole generally, it's always the big stories are led by some sort of hedge fund, and they've got a negative view on a company. You just have to look at a few years ago the GameStop story. Obviously, the hedge fund weren't a believer in that company. Now they lost due to, if you don't know the story, they lost due to a whole bunch of retail traders that were going against them effectively. I think I'm pretty sure they went out of business. But there's a good movie out on that called Dumb Money now. So if you look out for that, that's a great movie on that GameStop story there. And then obviously the big one, which was the housing crisis, and I can't remember what the guy was called, but he actually was a successful short, right? And the movie's called The Big Short.
Yes, that was Michael Burberry.
Michael Burberry, right? So that was a successful short, but obviously depicted in the movie was how much pain he had to go through with all his shareholders going, how much of a loss they were making before it actually collapsed, right? Before the housing collapse actually happened. So it's a couple of great stories there that really glorify short selling in one sense. But all right. Let's one more question, Jason. Now I know you don't do it a lot, but you do obviously look at short selling. What are the entry and exit criteria, just from a technical analysis perspective of short selling?
Yeah, it's I do it through Motion Trader for members, but it's not something I really promote. So I don't talk about it when people are thinking about joining Motion Trader. It's really Motion Trader is focused on looking for the opportunities to buy. But some people like the idea of short selling, so I do include some short signals as well. And it's largely the opposite to buying, in that, so when I'm looking to buy a stock, it's looking to buy a stock which is above rising moving averages. When looking to short a stock, we're looking for stocks which are declining below falling moving averages. So just get an example, and so this is this is a textbook best case scenario sort of example. and we'll balance this with the other side of it in a moment. A company called Marley Spoon. They had a big run during 2020 into 2021. It's subscription service for meal delivery or food delivery or something along those lines. So it was interesting stock, doing well for a bit, but then it sort of peaked, started to roll over. Moving averages has crossed. Big break to the downside. And so this is where I get a sell signal for Marley Spoon. And it's been a case, it's still in the motion trader short portfolio. It's down 98% or something like that. So a nice wide trailing stop, and it follows it all the way down. So that's what I think a lot of people think when they think going short. They think, oh, I'll just ride a stock all the way down. Most of them don't do that. This is another example. Same sort of situation. This is a stock called Sims Limited, involved with metals. It's a metals-orientated company. We had a peak in the stock, started to fall, bit of sideways movement, then breaks to the downside, get a sell signal, but then no sooner we get the sell signal, below the moving averages, declining moving averages, looks like it could fall further, then we get a strong rally. And this is what I was talking about earlier in terms of volatility with shorts. So it's now back to where the short signal was, but it's gone there via a 30 or 40% rally. So shorting's difficult. It's more volatile than most upside trades, and that makes it difficult. It's difficult to trade with when you get these large swings.
Yeah, very good. All right. So basically, the opposite. You're always looking at just the opposite of what you would with a long trade, right?
It's the same principles. Right. It's going with momentum, but just remembering that it's often a jerkier ride down than on the way up. So remember, up by the elevator, down via an escalator, which tends to hit the bottom and then bounce up and then fall again. So it's a harder ride. It's a real zigzagging, white knuckle ride lower a lot of the time. You can be on something which is falling, but it can have a 30, 40% bear market rally and then roll over and back at new lows within a couple of months. So it is harder more often than not on the short side.
Fair enough. All right, guys. If there's any stocks you want us to analyse, please put it in the chat. We will have a look at them. Thank you for all that explanation around short selling, Jason. I think it's great for viewers to be able to have a few stories to look at for themselves. And if you haven't looked at, if you want to watch some entertainment on it, there's some great movies and great documentaries you can Google, as we've mentioned in this thing. And Scott's also mentioned a good book on the housing short. It's called Shorting the US Housing Market, funnily enough, by John Paulson. So that's another one. All right, I think we've got a couple already come through, Jason. I might get you to have a look at one of mine as well, if we've got the time. So let's start with SSM, please. SSM.
I think that might be Service Stream. That's the one, Service Stream. Yeah, look, so a nice rally over the last few days off the moving averages. It's just looking where it's come from, big decline, moved from below the averages to above the averages last year. Nice initial rally, and then this is the thing it's kind of like what I'm talking about earlier with the ASX 200, that big rallies often lead to longer consolidations. And this has had that sideways consolidation. So it went from stretched above the averages to back to the 50-day, chopped around back to the 100-day, chugged along it for a while. And now it's broken to the top side again. I've actually got this stock in my own portfolio, and I'm just holding it. There's no thoughts of selling it, no thoughts of selling down, taking partial profits. I'll just use the wide trailing stop and see where it goes. I've had it in my portfolio for a while, so I've seen off a lot of this volatility, and that's the thing with I I don't remember when I bought it. Would have probably been a motion trader signal back in June 23 when the moving averages cross broke to a 70-day high, and the wide trailing stop means we can see off a lot of this volatility and give the trend a chance to develop. And now it's continuing to develop to the upside. So this remains a hold, and just see where this runs.
Fair enough. Let's have a look at NEM, please.
Is that NEM?
Yeah.
Newmont. So we'll look at the US listing. There's an ASX listing that probably won't have too much data. Newmont hasn't been doing well at all. It's like it's had a new low last night. It's which is quite extraordinary when you look at where the gold price is. The gold price is on the cusp of breaking to all-time highs. Yet Newmont and several other of the large gold companies, and all gold companies more often than not, are struggling. There's this real disconnect between the gold price, and the companies that mine it. This is a clear downward trend, and it's a stock that's breaking lower. There's nothing here that says it's time to buy. If anything, it's saying that this would be an exit, not a buy. It's at its lowest level since. Let's just mark that out. Yeah, so you got to come all the way back over here to when's that? 2018. It's down at 2018 levels. A lot's happened since 2018, and it's gone up, and now it's right back to where it started. Gold is much higher than where it was in 2018. So it's a hard thing with working out what's going on with gold at the moment. Often the two would be in sync, gold stocks and gold price. But at the moment, the price action is saying gold stocks it's not the time to be buying. It's going to take time for this to stabilize and get back above those moving averages. I don't understand why it's falling. So it's best when you don't understand why something's falling, stay away.
I like that theory. Keep it simple. Don't understand. Don't do it. Short selling examples: NHC and WHC. So let's start with NHC.
So the coal stocks. Well, and this is the interesting one of the things with shorting is you don't want to short what could be just part of an ongoing big consolidation. So the coal stocks generally have had big runs, and now they're like, is this part of a sideways consolidation, or is it part of a breakdown? We'll only know in hindsight. It's probably at the point where, look, maybe you could consider this is now breaking down. It's broken below a previous low point. The moving averages have crossed. They're turning even more to the downside. There's every chance there's a strong rally back to the averages, and then it turns lower again. So this is one of the difficulties with shorting. Do you short it now and have a wide stop that can withstand a strong rally back, which could also be just part of a new move higher, or do you wait for a bit and then risk missing it because it falls again? So there's a lot more volatility to deal with, but it's certainly a stock which is which is in a vulnerable position. It's at new lows below declining moving averages, but it's just how does it play out from here? And many ways that could happen. And the other one, WHC Whitehaven. Imagine the price action's going to look. No, it's similar but different. It's like there. I probably wouldn't. I don't know that I'd have the moving averages haven't crossed yet, but the price is below the moving averages. So it's developing into a vulnerable position. But and depends on your view. If you've got like a big picture negative view on coal, these are stocks to consider shorting because they are at higher levels and there is momentum coming to the downside. You just got to work out, how am I going to manage my risk around these stocks to see off the potential of large intervening rallies that do frequent these downward trends.
Yeah, I know we touched on this part of technical analysis last year, Jason, but that looks like a bit of a channel forming there on Whitehaven as well, right? So could you draw a channel going from there to there, and if it broke that channel, then that's where you'd really not worry about it.
You're looking at a channel up through the rising channel. It doesn't quite.
That's right.
I do see what you mean. It's got that general feel to it, but it's hard to actually like line up the points on this one. So it's got that feel to it, but I can't connect that starting point to the low because then it won't work. But yeah, it's very, and sometimes you can't quite line everything up, and you go, I can see the feel to it, and that's where just having, and which you've certainly got. You've got that chart eye. You can sort of see, you can see how the structure is without drawing the lines on it, but then you draw the lines and you go, well, yeah, it doesn't quite line up, but it's definitely got that look to it. So you get a stock like Whitehaven, it breaks below its low from last week, and maybe it can pick up some momentum to the downside. It's not in a strong technical position at the moment.
Yeah. All right, let's have a look at NTI.
NTI. So let's just see where it's come from. So it looks like a smaller stock. It's a pretty volatile sort of stock. Like, it's given us. Like, you can see how like these signals that don't always go anywhere can develop as well, because we had a nice run, a consolidation, a breakout to the top. So this was during 2022, and initial run, then the run just stalled and came back. So like, what's it doing this time? Is this going to be something different, or is it just going to be another false dawn where we get a bit of a run and then it comes back? It's from the positive standpoint, it is above rising moving averages. It's like such a, and this is the problem with these low price stocks, in that some of them can develop into really nice trends that can go up tenfold, but then others just whip around and they're difficult and they never really go anywhere. It's neurotech, so I'm guessing it's some sort of a biotech, and they can be they can be fantastic, or they can be tricky. So look, for someone who likes it, and maybe they're in it on the initial momentum, it's a stock. If I owned it, I'd hold it. I'd see where it goes, because sometimes these trends can really extend upwards. I can use a trailing stop on it. A trailing stop on a stock like this for me would be probably back at around maybe 7 cents. So I'm risking plenty to stay on board, but I'm well aware that these stocks do move around quite a bit, have a lot of choppiness. And if I get stopped out, well, so be it. But if it can help me stay in a stock that goes to $1, goes up tenfold, well, that's great. But then I know odds probably favour that it won't do that. It will come back and get stopped out. But yeah, look, it's in the game. It's above the moving averages. I'd let it run. I'd use a trailing stop, see where it goes.
Okay, what about VYS?
VYS. Just seeing where it's come from. So yeah, big decline phase. It's it's another low price one. Well, this is one where if I had it, I'd be holding it. The buy signal for this, for its recent run, would have been when the moving averages crossed and 70-day highs, probably back in January last year. But then there's always buying points along the way. Got the pullback to the moving averages, got another break higher, pulling back to the averages now. So if I'm in this, I'm staying in it. I'm using that wide trailing stop, try and see off volatility, see if this trend extends. If I'm thinking of buying it, well, look, there's one scenario which says, look, buying it around this retest of the moving averages, see if it goes sideways for a while and then starts to rally again, or alternatively buying it on break to new highs. That would be probably less risk with that. buying at current levels, you're preempting a rally back to new highs, but that doesn't always happen. Sometimes they just peak and they just start to roll over, and you've got to work out, okay, where would my exit point be in that case? And then you cut the position. But look, another stock with potential.
Fair enough. And let's finish off with DRO, please.
Drone Shield. Look, a lot of the things I just said with that previous stock. It's well, this is actually a motion trader stock. The signal was back in December when we got the moving averages crossed. We got a breakout. Got some of these myself. Letting it run, it is stretched above these moving averages. I'm wondering when the pullback's going to come, and it's got the potential to get quite volatile, a pullback in this stock. But like, who knows? So it could could rally further before it does pull back. I don't know. Nobody knows. It is a vertical ascent at the moment, and it's almost certainly going to come back to those averages. It's just like, where does it come back from? I'd find it a really difficult stock to buy at current levels, because, like, how do you manage your risk around it? The stop has to be fairly wide. And when you look at it on a weekly chart, like it's up it is at all-time highs. It's like, how high can this go? Again, nobody knows. It's broken out of this big range. You can actually draw a big sideways range, which it's come out of. Like, is there going to be a scenario where this zigzags lower over several months and cools off and then runs again? Well, like, there's all sorts of scenarios. Or does it just come crashing back the way that went up? And that can happen too. That's why we have the exit strategy, the trailing stop, to get us out should that happen. But if it's just a volatile sideways range, hopefully the wide trailing stop can see that off and keep us in. So we're trying to have that each way bet. We've got our exit point, but we're also trying to stay in to see whether this develops into something even bigger. But it's running, it's trending higher. As I say, I've got it. I'm keeping it at this point with that wide trailing stop.
And it's one of my FOMO stocks, I think. Let's finish off with Kogan, please.
Kogan, was it?
Kogan, KGN.
Oh, KGN.
They must have had some results or something.
Yeah. So this has been a bit of a volatile one lately. It's in that it's rally off the lows has been quite stop-start. So you get a good break, and then it comes back. A good break, then it all gives it all back. Then last year we had a good run up, then it gave it all back. So it's been a tough one. It's been a tough one to get on and stay on, even with a wide trailing stop. Just looking at the pullback last year, that was 40%. It's like, that's going to take out most trailing stops. I think there was a motion trader position from last year, which was initially looking good, but I'm pretty sure this pullback got it. Even the wide trailing stop, it's going to get taken out by a stock with that sort of volatility. There may have been another signal recently with the moving averages turning back up, 70-day high. I think there was another entry signal for this, and now this time it's run again. It's for me, it'd be a tough one to buy here, given that it is so stretched above those averages, and it has been inclined to have these big pullbacks. But if I had it, I'd if I bought it on the buy signal a couple of weeks ago, I'd certainly be holding it and see whether this one actually runs, because that can happen. You can get a stock which lets you down 2, 3 times, 4 times in a row, and then on the 5th occasion it goes, and it goes really well. So you don't want to just say, look, this stock is always prone to coming back and being disappointing, because one day it could just go, and you can get a big clean rally. So look, not dissimilar to the price action we saw during this period in 2019. It was like a stop-start sequences: rally, big pullback, rally, pullback. That was during the COVID period, and then we got the big run where it did go. So I always give a trend the benefit of the doubt. I don't want to do anything to interfere with the compounding process within a big trend. So I'll let them run and give them room to move about and see what they do. And you only need like 5 or 10% of your portfolio really runs a long way. That sets the whole thing up, provided you can manage your downside on the ones that don't work, and you get that middle section which sort of like move along with modest or moderate gains. You only need 5 or 10% of your portfolio to really go gangbusters, and that can be a market-beating portfolio. So that's why I always stress it's about when something's working, just let it keep working, see where it goes, and it's the ones that really go which can make all the difference.
Yeah, so for all the talk around cost of living, retailers are doing really well at the moment. So it's a bit of an opposite story there. You got the fearful stories about cost, but everyone's struggling. But there's still a lot of spending going on because Nick Scali's and other retailers done really well. Retail stocks are doing well, it seems like.
It's been showing up in the price action for several months.
Yeah.
And so the headlines, and this is the thing, you can't trade based on or invest based on the headlines. The headlines are telling you what has happened, whereas the price action is trying to help us identify what could be starting to happen and looking at the possibilities moving forward. And so whatever they may be, the price action has been supportive of those retail stocks for a few months.
Yeah. Yep. All right. Let's. There's a quick question here about the gold there, Jason. We'll finish up on that. Why do you think there's the disconnect between the gold companies and the actual gold price? Do you think it's giving us a bit of a sign that potentially gold's coming to an end? Right?
Yeah, it's a really difficult one, and I don't know. I think it's a flag. It's a warning flag that something's not quite right. So I've got a long position in gold, but I have cut it back over the last few weeks because just seeing this disconnect, and it has been gold stocks that I have exited. So it's not like saying, oh look, I'm going to give these gold stocks a little bit longer because the gold price looks so close to going. Had I been doing that, I'd be losing money just holding and hoping that they're going to quickly snap back. I don't know. I can't think of an instance where this has happened. I can't think of an example where we've had gold knocking on the door of all-time highs and a lot of these big gold stocks really struggling. Whether it's to do with the cost of extracting the gold, I don't know. But it's not the usual setup. So it's just I think it's a cause for some caution with approaching gold and that gold sector generally. It could be you look at put a gold chart up on a weekly basis. It looks like it could be one of the great trends of the next few years, but it's not being confirmed with what we're seeing in the gold stock. So you just got to question things and be cautious and manage risk. And it just shows that there's no certainties in the market, and we've always got to think, okay, what if I'm wrong? What if I'm long gold? And what if I'm wrong? And maybe these gold stocks are giving us a sign that we shouldn't be too aggressive in this sector at this point because something's out of sync.
Yeah. All right, that's a great way to wrap up. Thank you very much for your education and thoughts today, Jason. To everyone else, thank you for the questions and ideas as well. Just remember, this is general advice only. You've got to do your own research. Whatever we say or do is all in general in nature, nothing personal. Please go and seek your own personal advice. Other than that, please like and subscribe. I'm enjoying doing this. I hope you are too, and I hope the crowd's enjoying it. And we continue on, right, for another week of these great live and learners. All right, so
all sounds good.
Thanks, Jason.
It's been great, viewers. Thanks for joining us. Thanks for being with us.
And don't forget to put those some of those shows on your watch list this week, please. As in Netflix watch list, not on your stock watch list. All right. So thank you very much, Jason. Thank you very much, everyone. I wish you all the best and have a great week ahead. And see you next week. Take care.